Alright, what go family? So, you know the whole bold saga that's happening. Oh, he lose 2 billion Jamaican dollars from SSL, etc. etc. Personally, I don't really want to say much about it until everything comes to light, so I won't go to assumption. However, I was in a Telegram group and I saw this chart. The chart is on basically the capital to risk weighted average for each bank. Now, I have to explain, so this is the explanation. So with that said, like, share, comment, subscribe to a friend, and let's begin. So first thing first, out of the capital to risk weighted average, what is a bank's capital? Capital is really just basically what the bank has as its resources, which is equity and reserves. These are available to banks to absorb losses and maintain its solvency, and is to also protect depositors and creditors in the event of unexpected loss, i.e. in this case scenario. And typically banks in any country have their own regulations and requirements based on certain stuff, and as you can see for FSC it's showing 14%. So say from bank have 14%, then them alright. However, what I'm going to do is break it down, give an example, and I hope after you kind of understand what capital to risk weighted average means. First, what we're going to do is explain what is risk weighted assets, and basically it just explains a bank's capital adequacy compared to the bank's capital in the amount of risk weighted assets on its balance sheet. Risk weighted assets are the assets that a bank holds, such as loan securities that have been assigned different levels of risk. The higher the risk, the higher the weight. I learned this in like last semester of college economics and financial institutions. So basically I'm going to show you something, and for now ignore the numbers. I'm going to use it for an example that we had gotten from last semester. So ignore the 3 million, the 10 million, What we're focusing on is the extreme right and the extreme left. So basically the reserves that a bank have, the treasury securities, are rated at 0, meaning that you have the money basically. So a bank's reserve is literally cash you have, so you can't lose cash if you already have it. And in reserves now, our treasury securities are money from government, and always say government money is the safest money, so there's that. As you go down, you see agency securities is 0.20, municipal bonds 0.50, same residential mortgage, real estate loans are 1, commercial loans, fixed assets, letter of credit, and so on. Those are 1s, meaning that whatever dollar value it is, that's the amount of risk that you stand to lose basically. But as mentioned, banks make money predominantly from loans and investments in our holdings in commercial papers and them some there and so on and so forth. However, I'm going to get an example, and then I hope after this it kind of helps you to understand. So for this example, we're going to use First National Bank, which is the example of a bank, not necessarily a bank. And basically you can see that reserves 3 million, treasury securities 10 million, government agency, and everything else. You can see the figures down on the asset side, and checkable deposits, those are money who invest, non-transactional, those are liability. We don't really focus on liability as of right now, we just focus on the assets. So that's just like a basic example of a balance sheet of a bank. Now back to the whole example that I showed earlier, now coming in contact with all of the figures. So basically when you look at it, 0 times 3 million going to be 0, 0 times 10 million going to be 10, and so on if you do the calculation. So 0.20 of 7 million, 0.50 of 10 million, and that's how they weight each asset. Even though they might have 7 million in agency securities, only 20% of that you might risk losing. Easy me, and as you go lower, so like say commercial loans, that is 1, you only know $35 million, you stand for lose probably $35 million. So whenever you do that calculation, like 0 times 3 million, so on, so on, so on, so on, you end up with 91.4 million in total risk adjusted assets, and that is the latter part. So I already explained what is the capital, and now we just explain what is the risk-weighted asset. So putting those two together now, you will see that the capital divided by the assets, which in this example was $7 million they have in capital, as you can see from the balance sheet. So at the end of all that, the bank capital to risk-weighted assets would have ended up being 7.65%. Alright, so, and I hope you understand. So going back to the whole picture that they sent about the capital risk-weighted average, FSC warning level is 14%. So it just means that the farther you are away from 14% is the better off as it relates to capital to risk-weighted assets you have on your books. So in this example, you can see that the closest person, well, the person that is under it would be Sagicor. VMBS is right above it. JMB is a bit more above it, and at the top you can see that Scotia Investments is far from it. So basically they have half the capital that the risk-weighted assets are. So yeah, and I really hope that helped you guys. I know the short video, it was just explaining this. So catch you in the next one. Peace.